How is everybody doing this week? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. This is our flagship show, if you will, the weekly banking update, where I get into kind of all the general news and economic information and just different things kind of going on around the banking industry. Before we get started, I just want to mention a couple things. So I posted up a bunch of new episodes this weekend. If you haven't been following my book review of The Lords of Easy Money, that book is so critical and so important. I decided to literally go down and literally go through and break it down chapter by chapter. And we're just walking through the whole thing because there's just so much jam packed into that book. So I got basically episodes 5 and 6 of that up this weekend. So I hope people will go on and continue checking that out. We're through chapters basically 4 and 5. We got one chapter 6 left in the first section of the book. We'll do that. I'll do that next week. So if you haven't had a chance to check that series out, check it out. And I think that is a great one where you just need to kind of sit down. If you got a beer or a cup of coffee or something, and you just want to, listen to something because those episodes are a little longer. They have a tendency to be about 30, 40 minutes. And they're deep. They're deep. I'm throwing a lot of we're going through the book, but I'm throwing a lot of information at you. There's a lot of stuff to think about there. So if you have time, if you're sitting there, just again, great one to go through, great couple episodes to go through, but definitely see if you could find some quiet time or a little bit quieter time to sit down and listen to those and really think and process what's going on in those episodes and what the Fed is doing. So that being said, put out a bunch of episodes this week. I had kind of an inflation update looking at the inflationary numbers that came out this week with the CPI, the PPI, consumer prices. So check that out when you have a chance. I did one on, there was an interesting article on the kind of craziness with the college admissions right now. So I did a very short episode on that this week, just on an article that I saw in the Wall Street Journal, just about kind of the chaos and confusion in the college admissions process. So if you got any little ones going to college, you might want to check that one out. I did an update on Bank de Novo or bank startups and M&A news. So that was I think there's a lot of good information there if you just want to get a feel for the startup environment in the banking industry and what's going on in terms of merger and acquisition numbers right now. So check that one out. I added a 7th installment into the crypto series. Talked a little bit about the craziness that happened this week with Binance and the 2 executives that got held in Nigeria and accused of wrecking Nigeria's currency, which is kind of crazy. And then I also talked a little bit about Larry Fink and BlackRock doing a 180 and their new love affair with Bitcoin right now, as it were. So those episodes are all out there right now. So please go and check out some of that stuff. So I'm going to kick off here, and I'm going to talk about some of the economic indicators that are coming up this week. And then we're going to go back and look at the week that was. I'll share a bunch of news with you. And then I want to share just a couple of pieces from Emily McCormick and Naomi Snyder, who are both editors at Bank Director. They had a couple of interesting pieces on the mortgage squeeze and the discount window that I just wanted to share with everybody at the end that I thought people might like. So let's take a look at what are some of the economic indicators coming up this week. Okay, so on Tuesday, we got building permits and we got housing starts. On Wednesday, we got the FOMC statement at 2:00, followed by the Federal Reserve interest rate decision also at 2:00. And then we got the FOMC press conference at 2:30. So big day on Wednesday for the Fed. I'm expecting that they're not going to do anything. They're just going to stand pat. And they're going to say we're going to look at cutting interest rates later in the year, and that nothing's really changed. And that's what I'm expecting. Thursday, we got continuing jobless claims, we got initial jobless claims, and we got the Philadelphia Fed Manufacturing Index, and then we also have existing home sales. So a lot of economic data coming out on Thursday this week. So we got some housing data, we got some labor market data, and then we got the Fed coming up with their statements, and we got their interest rate decision, and then the press conference coming up on Wednesday. So a lot of interesting, good stuff coming out this week. So with that, let's look at some news and stuff that some of the things that came out this week. Okay, The Second U.S. Circuit Court of Appeals in Manhattan revived a lawsuit against Binance Holdings, accusing the cryptocurrency exchange giant of violating U.S. securities laws by selling unregistered tokens that lost most of their value, Reuters reported. The appeals court decision issued March 8th reversed a March 2022 ruling by U.S. District Judge Andrew Carter in Manhattan and returned the case to him. U.S. Securities and Exchange Commissioner Chair Gary Gensler engaged in an argument, spicy, with Investment Advisor Associate Head Karen Barr at the group's annual compliance conference in Washington over the agency's proposed rule on conflicts of interest associated with broker-dealers and investment advisors' use of predictive data analytics. The attorney generals of 16 states accused Wells Fargo and Company of discriminating against customers who are out of step with the Biden administration's policies, like those not aligned with the government's net zero carbon emissions targets, those in the firearms industry, and former Republican candidates by denying them banking services and abruptly terminating their accounts. In a letter to Wells Fargo CEO Charles Scharf, the attorneys general of Montana, Arkansas, Idaho, Indiana, Kansas, Louisiana, Mississippi, Missouri, Nebraska, New Hampshire, Ohio, South Carolina, Virginia, West Virginia, Utah, and Wyoming demanded that the banking giant stop its debanking practice and answer their questions on the matter by April 4th. So we'll see what happens with that. Fidelity Investments removed about 700 jobs last week, the asset manager's first round of layoffs since 2017, the Wall Street Journal reported, citing a statement from a Fidelity spokeswoman. Less than 1% of the Boston company's workforce was affected by the cuts, a move aimed at ensuring the company remains competitive, according to the report. Also, a little economic news. So they said let's see here, who's this from? This is from the Labor Department, reported that the economy added 275,000 jobs in February, and the unemployment rate increased to 3.9% from 3.7%. And average hourly earnings rose 0.1% in February and 4.3% over the year. And I'm the Easter Bunny, folks. I can't wait to look at those BS job numbers. Get that out of here. All right, what else we got here? Okay, so JP Morgan Chase and Company CEO Jamie Dimon said the Federal Reserve should wait past June before it starts cutting interest rates, as the central bank needs to be dependent on data and build its credibility in fighting inflation, Reuters reported, citing Dimon's remarks at a business summit. Okay, not bad. I mean, I don't think he's not wrong there, but we'll see what happens. Bank of America, their top executives saw pay increases in 2023, while CEO Brian Moynihan's total compensation last year went down by 3.45% year over year. Meanwhile, Bank of America plans to increase its headcount as demand from clients pushes it to expand its commodity energy transition business and its presence in global gas and power markets, as well as in environmental products trading, Bloomberg News reported. I'll have more on New York Community Bank in a minute. I'm going to hold that one for a second. So lawmakers on both sides of the aisle are questioning banking regulators' response to the March 2023 banking sector crisis 1 year after the collapse of Silicon Valley Bank, American Banker reported. Senator Bill Hagerty wrote the FDIC a letter asking about its sale of a part of the loan portfolio of the failed Signature Bank, suggesting that the regulator might not have chosen the highest bid for the sale, the report said. On the same day, Elizabeth Warren sent a letter to federal regulators asking for an update on their plans to strengthen regulatory standards for banks with assets of $100 billion or more. So interesting. So more to come in the weeks and months ahead on that, I'm sure. FDIC Vice Chair Travis Hill flagged downsides of the current regulatory approach toward the usage of blockchain and distributed ledger technology by banks, stating that a lack of regulatory clarity could jeopardize the U.S.'s influence in the sector, especially when global standards are being established directly or indirectly with any non-U.S. jurisdictions actively engaged in this area. So, okay. The ICB group urged support for trigger leads bill ahead of hearing. Now, this is an important one. So we've got this bill right now, which I believe is in the House. So after consumers apply for a residential mortgage, credit reporting agencies, not the banks, it's important to know, not the banks, because the banks can't do this. It's the credit reporting agencies. It's Experian, Equifax, and TransUnion. They are selling your contact information, which is leading to an influx of solicitations. The current process for a consumer to opt out of these trigger leads can be confusing and does not take effect immediately, which can cause consumer confusion. So this is kind of a bipartisan issue here, where Democrats and Republicans are both working to try to get this resolved, to try to pass this legislation, which would stop the consumer reporting agencies from basically selling this information out there. So hopefully they'll get that under control, but that's definitely something that needs to be supported. FDIC Chair Travis Hill said his agency should update its guidelines on digital assets to open the door to bank use of blockchain technology. Again, this gets back to this whole issue. If you go and watch the episode I did on the crypto series, I talk a little bit in there about regulation around crypto and about how, the regulators just continue to kind of pussyfoot around this and like, oh, we might do this. Oh, we might do that. Like, well, it's like, okay, well, maybe you guys will get to it one day. You've only been talking about it for about 3 years now. We'll see. Okay. What else we got here? We got CME Group will enter the U.S. Treasury clearing business, the Financial Times reported, citing CME CEO Terry Duffy. CME is the first exchange company to disclose its goal of grabbing a lucrative slice of the world's biggest bond market, the report noted. So interesting. What else we got? Financial institutions, including Goldman Sachs, Bank of New York Mellon, and CBOE Global Markets Inc. completed a series of pilot tests on the blockchain network called Canton Network, launched in May of 2023 by startup Digital Asset Holdings. Bloomberg News reported, citing an interview with Eric Saraniecki, co-founder and head of strategic initiatives at Digital Assets. Canton Network aims to link separate systems in finance and digital assets as to unlock the potential of synchronized financial markets. Grayscale Investments plans to launch Grayscale Bitcoin Mini Trust, a clone of the biggest Bitcoin fund, as the cryptocurrency asset manager loses billions to lower cost rivals, Bloomberg News reported, citing a regulatory filing. The proposed mini exchange traded fund would be physically backed by Bitcoin and trade under the ticker BTC, according to the report. Okay. A group of Wall Street executives are leading a new venture called Porticos Capital, intending to take over failed U.S. banks once the FDIC closes them, Financial Times reported, citing an official filing. Porticos was approved last year by the Office of the Comptroller of the Currency to run as a bank holding company once it buys a failed bank, according to the report. The company does not plan to go public, but intends to raise money through a public offering. So that's kind of interesting. So this group of Wall Street executives is, they're obviously expecting a few banks to fail. So we'll see what happens. So this is interesting, and perhaps the most important thing I've got here. So the U.S. is falling behind in the global race to launch a central bank digital currency, Reuters reported, citing a report by the Atlantic Council think tank. The report said that all G20 countries except Argentina are in the advanced stages of developing digital currencies, with 36 pilot projects underway, according to the report. Yeah, I'm going to do a whole episode on central bank digital currency. I'm not in favor of central bank digital currency. I do not want central bank digital currency. I have a lot of reasons for not wanting central bank digital currency, but the BIZ, the Bank of International Settlements, also known as the Central Bankers Bank, is hell-bent on getting this in. And they've got all these G20, all these central banks around the world working on this. Jeremy Powell did come out this week and said that the Federal Reserve is not working on central bank digital currency. That's BS. BS. Sorry. Yeah, they're working on it. Here's an interesting one. Around 24 financial institutions in the U.S. reported about 165 million in cryptocurrency transactions linked to Hamas in the last few years, the Wall Street Journal reported, citing a report by the U.S. Treasury Department's FinCEN network sent to Congress. We continue to assess that Hamas and other terrorists have a preference for the use of traditional financial products and services, but I remain concerned that as we cut off their access to traditional finances, these groups will increasingly turn to virtual assets. How did 24 financial institutions in the United States, which have nothing to do with cryptocurrency, by the way, how did they report that 165 million cryptocurrency transactions were linked to Hamas? I find that interesting. We're going to have to dwell on that one. Don't understand that one. We'll have to... Okay, the ICBA, the ThinkTech Accelerator participants showcase the solutions. So the ThinkTech Showcase, which is at the ICB Live 2024, featured product demos from participants in the sixth accelerator program, which focuses on small business, data analytics, and compliance. So I'll just tell you about a couple of these companies that are involved in this. So Azimuth provides automated full population compliance testing. The company called Conductive collects lending and loan servicing data to incorporate into underwriting and lending processes. Hulup Automation uses AI to automate the streamlined processes to support decisioning and governance. Monet, a cash flow analysis, forecasting, and guidance platform with data-driven tools and insights. Revio helps analyze transaction details to uncover deposit growth and revenue-generating opportunities. And then TrustStamp enables one-to-one and one-to-many identities without sacrificing biometric security or utility. And just some recognition here, Hulup Automation received the Banker's Choice Award, recognizing the most promising solution, the most valuable participant award for the most evolved offering. And then Conductive CEO Gopal Swami received the All Heart Award for demonstrating passion, empathy, and commitment to making a positive impact. Well, there you go. But no, if anybody has not had a chance to go to the ICBA website, they have the ThinkTech Accelerator on there. You can go check it out. I think it has its own website actually. But these are some great companies doing some really cool things. I've actually watched a couple of the product demo days that they've had the last few years, and it's actually some pretty cool stuff. So, okay, the CFPB is codifying guidelines for the 1033 standard setters. So this is open banking. I did a whole episode on this a couple of weeks ago. Everybody really needs to go watch that episode. Open banking and beneficial ownership information. You need to go watch those episodes. If you have not watched them, you need to go watch them. So the CFPB, they are hell-bent on just moving this open banking through. So the ICB's view, so in their December comment letter on the CFPB's proposal, ICBA urged the Bureau to exempt certain community banks from the proposed standards and to permit banks to charge third parties a reasonable fee for providing access to consumer information. It previously urged the Bureau to resist requiring banks to provide information outside the scope of Section 1033, limiting potentially harmful data requirements and tailor safe harbor protections to community banks. So what's the background real quick? So the Section 1033 of the Dodd-Frank Act requires covered financial institutions to make available to consumers and authorized third parties, i.e. PayPal, Google, Microsoft, you name it, certain data relating to consumers' transactions and accounts. The CFPB's proposal would require virtually every bank in the country to establish and maintain a developer portal that third-party companies could use to access consumer data with consumer authorization. Hell no. Hell no. Not in favor of this. Don't want it. You're never going to convince me. How are you going to convince me that my data being in the hands of somebody else makes it safer? Sorry. No. That would be no, and no. Okay, then all right, going on, not to diatribe on that too much there. So report validates ICBA's warnings on crypto money laundering gaps. So a new report on North Korea's use of cryptocurrency mixer Tornado Cash this week reflects ICBA's calls for the Financial Crimes Enforcement Network to combat crypto-based crimes. We got that. Here we go. Some more central bank digital currency news. So more than 130 countries exploring a central bank digital currency. The report. So more than 130 current countries and currency unions representing 98% of global GDP are exploring a central bank digital currency, according to a new Atlantic Council report. The report says its tally is up from 35 in May of 2022. Meanwhile, 68 countries are in the advanced phase of exploration, developing, piloting, and launching a CBDC. The U.S. state of play. While the report says the United States is in the development stage, the U.S. debate over whether to issue a CBDC remains active. Yes, absolutely. Okay, what else do we got here? Consumer business optimism. This is kind of interesting. So we've got here the ICB points to polling on credit unions following the latest acquisition of a credit union by a bank. So following the latest credit union acquisition of a community bank, ICBA pointed to its recently released polling data showing Americans support reforms to policies that arbitrarily favor credit unions. So in a post on X, ICBA said acquisitions of tax-paying community banks by tax-exempt and CRA-exempt credit unions harm consumers. ICBA also linked to its recent polling, which found 68% of adults say credit union customers should have the same consumer protections that banks provide, such as those provided by the CRA. 73% say credit union customers should have the same levels of protection against illegal discrimination as bank customers. And 54% say Congress should investigate whether the credit union tax exemption is still warranted. So kind of some very interesting information there. Obviously, a clear majority of people out there think that this, the whole, credit unions buying banks and credit unions not having to comply with CRA, that's something that needs to be investigated, needs to be looked into. So, okay, so let's get into some other stuff real quick. So, real quick update on New York Community Bank. So, if everybody went and saw my updated episode on that last week, so real quick, so New York Community Bank closed its previously announced $1.05 billion equity investment deal. So they got that done this week. And then here's real interesting news. So New York Community Bank, they blamed its board for lack of oversight responsibilities for its financial reporting weaknesses. In its delayed Form 10-K filing, the company, which detailed material weakness in its internal control, said it is now strengthening its internal control over financial reporting with, among other things, the appointment of new board directors as several members have resigned. A separate filing stated that outgoing CEO Thomas Cangemi and directors James Carpenter, Leslie Dunn, Lawrence Rosario Jr., Ronald Rosenfeld, and Robert Wan resigned March 11th from the board after the company got a $1.05 billion new capital infusion. Another gentleman, Lawrence Savares, also intends to resign effective upon the Form 10-K filing. David Treadwell plans to exit when a successor is named according to the filing. So obviously a lot of changes ongoing there, but basically they blamed the old board members and the old CEO for the lack of internal control. So why, and this is a couple articles here, why New York Community Bank raised capital instead of finding a buyer. And basically they said, it just wasn't a good time for, couldn't get good premiums. The bank was in financial distress, all this other stuff, yada, yada, yada. There were some fast options. And then New York Community Bancorp details material weakness in internal controls. So in its annual report, the 10-K filed for the year-end 10/31/2023, the company specified that its internal loan review process lacked an appropriate framework to make sure ratings were consistently accurate, timely, and appropriately challenged. It noted that the ineffective control activities connected with internal loan review affect its ability to accurately disclose loan rating classifications, identify problem loans, and ultimately the recognition of the allowance of credit losses for loans and leases. So yeah, no doubt, big problem there. So, okay. Let's run through some other things here, some other interesting things that I saw this week. So assessed value of Philadelphia office buildings to plummet by $1 billion, city officials project. Dubo, I think he's one of the Philadelphia officials, attributed the projected $1 billion decline to a flurry of assessment appeals As office property owners witness the sinking value of their buildings, they're petitioning the city to adjust their assessments accordingly. The vacancy rate for Philadelphia office buildings is creeping toward 25%, and reduced leasing revenue and rising interest rates over the past 2 years have squeezed property owners with floating rate loans. So obviously big announcement there. So property values in Philadelphia dropping, and undoubtedly same thing is going to be happening in, I would imagine, every major city in around the rest of the U.S. So cryptocurrency market news. Bitcoin plows past 72,000. Ether is up on Dencom upgrade optimism. So cryptocurrency, so Bitcoin rose above 69,000. Investors buy community bank and trust, plan geographic expansion. So you got that. U.S. wage inflation moderates, boosting the odds of a soft landing. Yeah, no. A year after Silicon Valley Bank collapsed, the rules are still catching up. Heard on Wall Street. It's kind of what we talked a little bit about earlier. People wanting, regulators and stuff wanting more information there. CFPB late fees would dent but not bend credit card issuers' profitability. So interesting. New wave of commission lawsuits targeted small real estate brokers. That's kind of, so you have all these lawsuits on the real estate industry that are going on right now. And I think it's ultimately going to have a huge effect on commissions that people pay the seller's agent, the buyer's agent, and how that's all going to work out. And I'm probably going to do just a whole nother separate episode just talking about this, because there's a lot to talk about there. Institutional investors broadly increase holdings in the Magnificent Seven stocks in the stock market. What else we got? U.S. banks still excluding bond loss trades to boost net interest margins and net income. Yes, the bank's bond portfolios are still in the negative. And, U.S. banks recognized $4.17 billion in realized losses on available for sale securities in the fourth quarter of 2023, down slightly from $4.29 billion in the linked quarter, but still up compared to any other quarter in the last 3 years. So, yeah, still trying to dig themselves out of the bond hole there. Retail investors flow into stocks again for fears of missing out on rally. And then I think that's about, here's an interesting one. So more Americans are treating their 401ks like cash machines. Automatic enrollment has swept more workers into 401k accounts, giving them some savings to draw on in emergencies. So so basically a lot of people are dipping into their 401ks and pulling money out because they can't make ends meet. So there you have it, folks. So that's kind of the news here. So I wanted to wrap up here this week with, like I said, a couple of things from Bank Director here. So the first one is called "Who's Afraid of the Discount Window?" So before Signature Bank's closure in March 12, 2023, it tried and failed to raise funds from the Federal Reserve's discount window, a facility that provides loans to supplement bank liquidity. Signature didn't have pre-approved collateral to pledge for the loan, according to a report from the Inspector General for the FDIC. The Federal Reserve's post-mortem review of Silicon Valley Bank, which failed 2 days earlier, said the bank similarly wasn't prepared to access this funding. The Fed's liquidity tool likely wouldn't have prevented those bank failures. It didn't save First Republic Bank, which regulators closed in May of 2023 after it borrowed $109 billion from the window, according to the Inspector General for the FDIC. That was on top of $30 billion deposited by the large banks. But many banks did benefit from the discount window and the Bank Term Funding Program, an emergency facility that was established immediately after Silicon Valley Bank's failure and expired on March 11th. Through those programs, the Fed lent funds to banks that were swept up in last year's liquidity crisis. One of those banks was Phoenix-based Western Alliance Bancorp, which is seen as a competitor to Silicon Valley Bank through its tech-focused Bridge Bank unit. Before the BTFP began on March 12th, Western Alliance borrowed $25 billion from the Fed based on company statements. After an initial deposit outflow of around 11%, deposits recovered over the rest of 2023, ending higher than the prior year. But by the end of the year, Western Alliance reported that it had paid off its entire BTFP loan, which totaled $1.3 billion as of September 2023. So the $70.9 billion that Western Alliance wasn't the only bank that took advantage of the BTFP. As of February 28th, the most recent data from the Fed, BTFP loans stood at $164 billion. Discount window borrowings totaled $2.2 billion, down from $117 billion roughly 2 weeks after Signature and Silicon Valley collapsed. As the Fed sunsets the emergency facility, a stigma remains around the discount window. Bankers worry about what using the facility could communicate to customers, shareholders, and regulators. It's the lender of last resort, said Bill Demchik, the CEO and chairman of Pittsburgh-based PNC Financial Services Group, at a Brookings Institute event in early March. The day you hit it for anything other than a test, you effectively have told the world you failed. So, I did not agree with the Fed ending the BTFP. I felt that, with the issues at New York Community Bank, with the issues going with the issues in commercial real estate are only going to continue to hit throughout the rest of the year and probably into 2025. So I didn't think that the Fed should have ended the BTFP program on Monday. I think they should have extended it for another year and just left it open. Left it there. It was another thing that banks could tap to get more liquidity to help them out if they ran into an issue. Now they're just left with the discount window. And like you said, the discount window is an interesting thing because not every bank has access to the discount window, whereas they did have access to the BTFP. So, I think this is a mistake by the Fed to let this sunset. I think they should have extended it for another year. Now, granted, if there is a problem, I'm sure they could always bring it right back. But like I said, I just think they should have left it out there. I just think that again, kind of taking away the punch bowl just adds to some of the uncertainty right now. And it is not a great thing. And then finally, the mortgage squeeze. So, normally, community groups such as the NAACP and the National Urban League don't fight bank regulations, but they are now. A coalition of community groups, real estate agents, banking, and state housing organizations have banded together under the auspices of the National Housing Conference to make the case that beefing up capital requirements for banks above $100 billion in assets would harm underserved communities. With interest rates as high as they are, we need all the lending to first-time homebuyers that we can get. Last summer's notice of proposed rulemaking from the OCC, the Federal Reserve, and the FDIC contains 166 references to mortgage. It includes provisions that would dramatically increase risk weights for mortgages with high loan-to-value ratios and certain other mortgages on bank balance sheets. The Housing Conference said in a letter to the agencies that the provisions would discourage lending to first-time home buyers and low and moderate income borrowers. The proposal would also impose a 10% cap on the mortgage services assets that very large banks could count toward Tier 1 common equity, down from the 25% currently. If the very large banks pull back on buying mortgage servicing assets, that could impact the rest of the market, the group argues. The agencies, however, said the rule would improve transparency and reduce variability and risk weighting across bank organizations. Plus, they specifically said that they don't intend to force higher risk weights on loans with high loan-to-value ratios that have private mortgage insurance. Still, it's startling to see so many provisions related to mortgages in the capital rule. Many banks across the country have pulled out of mortgage lending altogether since the passage of the Dodd-Frank Act in 2010, which made mortgages safer for borrowers but more costly for banks. The Housing Conference notes that banks account for 28% of all home purchase mortgage originations, down from about 70% pre-Dodd-Frank. Non-banks account for the rest. So again, a very interesting little piece there on kind of what's going on. And I agree with them completely. If they put these conditions basically on banks along with these new capital rules, that is, banks are not going to lend money on mortgages. They're going to pull back on their mortgage lending, especially to first-time home buyers. So I agree completely with what these groups are saying here in challenging this. Sometimes a lot of times, more regulation is not the answer. More regulation just causes more problems. So, but anyway, interesting news there. So I just want to wrap the things up or whatever. So I hope I hope everybody is enjoying these banking updates. I hope this is serving as kind of the main hub for all the different videos and activities, different things that I'm doing and I'm talking about. And, if you liking what you're seeing, I hope that you make sure to like, subscribe, share. That always helps the channel. Please make sure to leave your comments below. I try to get back to everybody as quick as I can. And remember, we are on YouTube, Rumble, and all major podcast platforms. And please make sure to check out the bankernextdoor.com. Would love feedback from people, what they think of the website there. And, but a lot of things going on, a lot of things happening, a lot of things going on in the banking world right now, a lot of uncertainty out there. And I will continue to stay on top of this thing and keep everybody updated. And I hope everyone has a wonderful weekend out there. And I will see everybody again next week. Thank you so much. Take care.